This is Tim Phillips, Chief Investment Officer at Phillips and Company Advisors, and I'd like to welcome you to our Q1 2022 look ahead. In the first quarter of 2022, and certainly throughout much of 2022, I look at this year as the thin green line with lots of threads that make up the difference between profit and loss, success and failure in equity markets throughout the globe. I hope our look ahead expounds on those thoughts. I always like to start the year ahead by looking back. And I always start the year by calling it the Wall Street parlor tricks. And it's simply the fact that Wall Street firms love to make predictions because investors love predictability. Last year, Wall Street expected the S&P to increase by 7.43%, and it actually increased by 27%. That's a 266% miss against their target. Again, GDP growth was expected at 3.9, grew by 4.9. That's about 25% off. The point being, Wall Street parlor tricks are incredibly precise, but incredibly inaccurate. Just by way of this year, the Wall Street Brain Trust is expecting the S&P to increase by about 3.58%, and we'll see how this year ends up. Needless to say, it's certainly much more muted in terms of expectations than years past. When you think about what drives the US economy, it's clearly consumption. That's 70% of our GDP. So what helps consumers spend money? Well, there's a few areas we look at. First, wages. We all know wages have been going up both in the goods and services sector, and that's a good thing. That fuels consumption. The other thing is jobs. While we're still below the peak level of jobs pre-pandemic, we've made up a lot of ground, 18.5 million jobs since April. That's great. That will fuel more consumption and certainly keep consumer confidence high. The other area that fuels consumption is debt. Consumers borrow and spend. And in terms of debt service as a percent of disposable personal income, they've got a long way to go to lever up. If they did lever up to kind of pre-Great Financial Crisis levels, that's $725 billion or a whopping 3.13% of GDP. So lots of fuel there. The one area that might erode that thin green line between expansionary and contraction is the personal savings rate. As you know, the United States government pumped a lot of fiscal stimulus into the consumers' pockets. You can see that with that March 2021, 26% of savings. Consumers saved it. They have been steadily and consistently spending down that savings and will soon be back to pre-pandemic levels, probably in Q1 2022. So again, much of what I see in the consumer looks very strong. The one little area that can tick over that thin green line is that spend down of precautionary savings. To keep the US economy and investors on the plus side of the thin green line, inflation must transition. We talked about wages in the prior slide being up, but inflation is eating away much of that purchasing power. As of this recording, November readings were at 6.8%. Of course, the Fed target for CPI is 2%. Much of what's driving inflation happens to be in just a couple components. Energy or gasoline, we all see that at the pumps. That's very high. Vehicle prices, that's generated by supply chain issues. And then the third area really is shelter or owner's equivalent rents for real estate. Those three areas are the biggest issues. If you strip some of that out, that core CPI would be fairly muted. Now, I do expect gasoline prices to tip over here in Q1 as we see futures prices for wholesale gas at fairly low levels and driving lower. The other area in terms of why I expect inflation to transition is the base effect. Inflation is measured on a base or rate change, year-over-year comparison. And you can see in the red, throughout much of 2021, inflation was screaming much higher. Now, when you do that year-over-year comparison, by the time you get to July and August, you're going to be working off very high base, which should drive inflation rates back down. It doesn't mean prices are going to drop. It just means the rate of change is going to moderate back to closer to Fed targets. And in fact, you can see in the lower right-hand side, the central tendency is for inflation to moderate back down in 2022 between 2.5% and 3%. Again, the Fed dropped the word transitory only because they were talking about transitory being such a quick spurt of inflation. They clearly believe inflation will moderate, but it'll take a few more months. Our view is the U.S. economy will moderate off inflation by July or August, with a couple high readings in the first quarter. Our view is as long as it moderates, we can stay on the plus side of that thin green line between profit and loss. Managing that inflationary spike is predominantly landing on the Federal Reserve's shoulders, and I think they're walking a very tight rope. I call it frenemies of the consumers. Are they going to be friends to the U.S. consumer in 2022, or are they going to be enemies to the consumer? They've clearly signaled rate increases will occur in the coming months and quarters. Right now, what's priced in is 2 rate increases at 25 basis points each sometime in 2022. Our expectations are could be 3 if that inflation doesn't moderate. And you can see that in the left-hand side of this slide. What's built in is a couple rate increases in 2022 and another few more in 2023. Verifying all of that is the yield curve. That looks like it's flattening at the long end, and that kind of signals the potential for a recession, or at least a policy error that can lead to a recession. So when we talk about that thin green line, the Fed is tight-roped, balanced right on that line, and we really can't afford a lot of policy errors out of the Fed in this coming quarter or in the year to come. To continue with that theme of the Fed Reserve tightrope and policy error recession, with a big giant question mark, let's first start with the taper, which they are beginning very soon. As you can see, when they have previous tapers in 2013, Treasury rates, the 10-year Treasury yield actually dropped, didn't increase, while the low end did. And in fact, U.S. equity prices rallied, with the S&P being up 15.7% during that period of time. Now, we know the Fed's going to do much more than just taper in 2022. We certainly believe they're going to raise interest rates consistent with other countries throughout the world. You can see much of the developed economies raising rates in 2022 and 2023, with perhaps exception of Brazil and Russia. That's the forward expectation. Now, the question is, so what? What does that mean for equity investors if they raise rates? In the last several tightening cycles, you can see markets tend to perform fairly well. 1 month, 3 months, 6 months. Throughout those tightening cycles, over periods of times, you can see the S&P 500 actually increasing in price. And the positivity rate's quite high. On a 1-year basis, it's a 10% average return at 78% of the time. Now, what happens if the Fed induces a recession? Again, it's the so what factor. Overall, as long as you have a long enough time horizon, you can still see, on average, equity prices tend to increase on a 1-year, 3-year, and 5-year basis, 21%, 53%, 112% over all of these periods of time that had some pretty dramatic episodes. The Great Recession you can look at. The Great Depression you can look at. As long as your time horizon's long enough, you can probably withstand the Fed policy areas. So again, they're on a tightrope. I think this fits that theme of thin green line, and we've got to be mindful of a big risk of policy error, not only in Q1, but throughout 2022. All things considered, in my worldview, there are really two things I always focus on. As you know, one is the consumer, and two is earnings. Over long periods of time, earnings matter most, particularly when it comes to price appreciation in stock. Coming into 2022, we've got some pretty high hurdles. 2021 corporate earnings were phenomenal. Now, unfortunately, rolling into 2022, compared to the last year's numbers, corporate earnings are going to look rather muted. In Q1, 6.8%, and overall full year at 8.7%. And that's with the consumer spending down precautionary savings, having continued wage growth, lifting more people back into employment, and making sure companies increase prices to offset wage costs and material costs. What I look for there is profit margins. How do their profit margins look? Well, my expectation in Q1 2022 and throughout much of 2022 is a dip in profit margins that will put more strain on corporate America. Again, this is all part of that thin green line theme. Again, this is part of pulling us back below that line, and especially when you consider forward price to earnings valuations. I mean, we're trading at 17% above 5-year valuations and a whopping 30% above 10-year. So it's priced for perfection. The S&P literally has to perform. The one area that can boost or we can exceed to the upside is share buybacks. When companies buy back their shares, they lower outstanding supply, which increases earnings per share. Throughout 2021, there was record share buybacks, and that should boost us throughout 2022. Another challenge this year, not that we need to talk about more challenges, but another challenge is certainly on the fixed income side. It looks like it's going to be another tough year. We talked about this time last year. Fixed income, particularly for those balanced portfolios, 60-40 portfolios, poses some tremendous challenges. This year, you could see year-to-date returns almost all negative across the various segments of fixed income. I draw your attention to the AGG. You had yields at 1.23, hardly enough to even cover even the smallest component of inflation, and total returns at minus 1.74. That's with a modest duration of 6 years, 6.6 years. Rolling forward, we expect about 2% return forecasts for AGG, and partly that's because shorter end rates are going up, the long end rates are hovering, so we're seeing that flattening of the yield curve. Our best bet for investors is to use active management in fixed income, manage duration and credit quality, and also focus on shorter end of the yield curve. And what I mean by shorter is slightly below the 10-year. Maybe it's in the 4 to 6 year range, which will be a pivot point. Doesn't mean you're safe. It just means you're going to find less volatility in all expectation. Now, two areas that pose some opportunities. Investment grade corporates, albeit very muted in tightening cycles, 1.98. And again, the other area probably is going to be in high yield corporate bond returns, and you can see that in the lower right. In tightening markets, it's about tightening interest rate environments, about 7%. That does help, but there's all kinds of credit risk. So it will be a blend of segments in fixed income that will drive overall positive returns, depending on how the Fed handles the taper as well as increasing rates throughout this year. Pivoting to developed markets, those headwinds look a little more challenging in terms of which side of the green line they're going to pivot on. Last year, there were record earnings growth for those companies in developed markets. This year, obviously, it's going to be very difficult for those companies to beat those hurdle rates. We're looking at full year 2022 at minus 14% earnings per share. First quarter, minus 5.4%. Now, the only saving grace is valuations are 30% discounted to US valuations, and they will have some moderating growth, but not bad. Fiscal policy in the European Union has been leaking out at a slower rate than it did in the US and in Asia. And so I expect a little bit more of a tailwind from fiscal policy support in Europe, and we get a little more constructive in spite of the fact that they're facing huge hurdles. UK GDP growth rates will tend to decline, Japan will tend to curl over, but Europe as a whole should benefit from European Union fiscal support that has been leaking out slowly last year, and I think more increasingly in 2022. One bright spot for 2022, or at least we hope will be a bright spot on the positive side of the green line, is emerging markets. They too have very high hurdle rates, but like the US, they expect to be in that 8.2% full year 2022 earnings per share growth, with Q1 coming at 7.2%. Now, apples to apples, I'd rather own emerging markets because they're trading at about a 47% discount to US. It doesn't mean pile everything into them, but it does mean make sure you have reasonable allocation to emerging markets because they have better GDP growth, in that 5%. China's certainly coming in at that 5.5 to 5.6%. India still at that higher 7% to 8% range. Those should all provide opportunities for investors to find returns to meet targets throughout 2022. Going a little deeper into emerging markets, let me hover on China for just a bit. Notwithstanding the geopolitical competition between China and the US for biggest economy in the world in the next 10 years, China still is on great progress, great tracking to meet their goal by 2035. Needless to say, as their economy gets bigger, growth rates in terms of percent get smaller. Expectations are between 5.5 and 6% GDP growth next year in China, much of it driven by consumption. China is slowly migrating to a consumption-oriented economy versus a planned investment economy, and that's a good thing. Giving the consumer power in China is positive and progressive for politics. Notwithstanding that transition, which will take some time and might take some pain, earnings per share growth will also look a little muted in the full year at 6.1%, with the trough being in Q1 and Q2. Now, the one thing we have to think about differently in China is they're at a different stage of the business cycle. They're kind of now at the bottom, emerging out, and they'll use some fiscal and monetary policy to drive that. Expectations are for better and more fiscal policy stimulus in the year to come. That should drive investor sentiment and more dollars into China. The good news about investment in China, it looks a little counter-cyclical to the United States. So you may get some of that low correlation relation unless there's a major event. We're still very constructive about allocating a small portion of portfolios to China. So our views and recommendations can be read here, and I won't cover all of them, but I think that theme about that thin green line and which way we break on it definitely paints the picture. We expect a choppy return to normal in monetary policy with tapering and rate increases, corporate earnings growth to be muted relative to last year, precautionary savings will be spent down, yet the consumer still looks pretty strong to me. GDP growth still looks expansionary, but we've got to be mindful of the Fed making major policy errors. Emerging markets continue to offer the best growth to valuation opportunities, and we should always be prepared for interest rate volatility that can create headwinds. Our recommendations are to return to neutral weight US equities, that's large, mid, small. That may be rebalancing out of some of the US equities and back into other areas. For example, maybe increasing just slightly your developed market exposure, but still maintaining an underweight to your policy. Continue to maintain an overweight to emerging markets. In my estimation, it's critical to use active management in fixed income to manage that duration risk, that credit quality, and that yield curve management, which I think is going to be very important just to eke out modest gains this year in fixed income. And in terms of especially, we still are constructive on base metals, not so much as a hedge against inflation, although that's true, but really equally as important as a transition to green energy assets, which are heavily reliant on aluminum and copper. You can look at our mean reversion dashboard here and see areas that are certainly trading well above mean and well below mean. Our macroeconomic dashboard definitely supports the US economy trading above that thin green line, but we have to be mindful of the fact that this is a fluid economy and things will shift. But as of now, Q1 looks to be a strong quarter for the US economy in the macro. I'd like to thank you for taking the time to review our Q1 2022 look ahead. You can find a link to our Q1 2022 China look ahead here. And of course, please email me with any feedback, comments, or questions. And by all means, connect with your advisor at any time regarding this material. We're wishing you and your family a healthy, happy, and prosperous 2022.